Hey everybody, Thomas Meister here. Today we're talking about don't just do it when it comes to your finances, and we're really going to be diving into how a lot of the other people in the industries that Ryan and Jeff are from are really kind of vilifying and really doing a disservice to the consumers, especially when in the mortgage industry, you can click a button nowadays, go $500,000 into debt. In the finance industry, there's companies where yes, maybe it's good for you to be buying stock, but if you're not an educated consumer, then we need to have a conversation. So Ryan, Jeff, how you guys doing today?
Doing
Doing
well.
good, man.
Thanks for inviting us.
Of course. Ryan, take it away. Why do people need to actually educate themselves?
Yeah, I think that, the reason we wanted Jeff on the call today was because when it comes to financial education, there's not a lot better. And I think the wealth gap that we're seeing in our country is going to be ever expanding as long as the larger, more well-capitalized companies continue to, as Tom said, vilify the educational process. I don't know if anyone watches this remembers, there was a Super Bowl commercial, I think it was 2, maybe 3 years ago, that Quicken ran, where there's a couple sitting down with a mortgage professional learning about private mortgage insurance and really valuable things they need to know. And some guy comes up from behind them with a phone and says, "Here, click here," and they click, and in 2 minutes they're pre-approved, right? And then they leave the guy's office kind of laughing. And it was to me, kind of an affront to everything that we should be trying to teach the consumer. But in the eyes of these larger transactional based companies, it makes more sense to keep the consumer undereducated, right? It makes sense to try and get people to think that speed and efficiency is more important than education and analysis. And same thing holds true in mortgage as it does in other areas of finance, right? Like the online E-Trade accounts where you can dump a bunch of money in and go play poker in a room that you have no business playing poker in, right? Your ability to trade on Robinhood and the terrible things we've seen from that, where people don't even understand what position they're in, and then they take their life, right? Because they were just playing a game they didn't understand. And that's obviously the most radical, terrible example of it. But from a mortgage perspective, the most important thing, if you're watching this as a consumer or a mortgage professional, real estate professional, please realize that just giving someone a pre-approval letter tells them what they can do. And yes, you can get a pre-approval letter fast. Technology will allow that. You'll be able to click and especially in a couple of years, you'll be able to click a few buttons. They'll be able to know your credit, all about your income, because that'll all be online. Your asset, your bank statements will be online, your payment history, everything they'll need can pre-approve you in a matter of minutes. And technology has allowed that and will continue to perpetuate that. The only challenge is that tells you what you can do, but it doesn't even remotely come close to telling you what you should do. And there's a very big difference between those two. A good example of this is, I'll share my screen real fast here, is if you are to go, let me see here. You guys see my screen?
Nope. You should have to.
Yes?
No.
Oh, no. Let me go back here. Oh, there we go. Screen one. Share.
And also, guys, if you stay through here till the end, Ryan and Jeff actually have some giveaways, some takeaways that we're going to be sharing, not only just some tips, but some also great resources, places that you can start, especially when it comes to enhancing your knowledge. Ryan, go ahead.
So this is an example, right? If you were to click those few buttons and get pre-approved and get a mortgage in 8 minutes, which you can do, you can get a 30-year fix at 2.99%, which is actually quite a bit higher than the national average. So a little bit higher interest rate. What?
Right now it is?
Correct. Yeah, we're about 2.75, 2.875 on any given day. But what you don't see here is the legal disclosure section, and very important, right? That this 30-year fixed loan comes with the cost of 1.875 points on top of all your other fees and title and escrow and taxes and insurance. So in Orange County, if you're getting a $500,000 loan, you're going to pay roughly $10,000 to acquire this higher than average interest rate. But you notice where it's not in bold letters, it's nowhere else. You have to click a button, you have to go down and you have to look with your with your magnifying glass to figure this out. And their expectation is that most people in America won't do that. They won't click that button. They won't look into it. So they're going to get to the closing table and they're going to see a bigger cost, and they're going to think, well, I guess this is just what it takes to get this loan. They're praying and they're really hoping that people don't have the education and the advice or the guidance, and that they just get a mortgage. And there's way more people in our society who will do that than will actually search out education, advice, and guidance. So I know it's my personal mission. I know it's one of Jeff's missions as well, to change what we are actively doing in the marketplace. Let me stop share here. So to change what we're doing and to be able to get people to realize this is not as easy as people make it seem. It's not like opening a credit card, right? It's not like putting money into a checking account, right? There's uncertainties. 44% of Americans have some form of regret within 2 years after they buy a home. And that's truly a study that they did about 3 years ago. And all of it was related to the fact that they didn't have enough information. They didn't regret buying a home. They just regretted, well, maybe they put too much money down. Maybe they didn't account for how much they need to spend after they bought the home on upgrades or furniture or anything else. Maybe they didn't have enough liquidity after the fact. Maybe they didn't, really analyze the purchase price or the monthly payment into their budget well enough. Maybe they bought too big or too small of a home. All these things would have been rectified if they took the time, but we are just not trending in that direction in our society. We're trending in the fast and easy direction, not the educated and intelligent direction.
Yeah,
right?
well, it's such an enticing, I guess, direction where in a very busy world, right? I guess they want us to have less decisions, right?
Well, I think
Yeah.
to add to that conversation, one of the most influential propositions in marketing nowadays, and quite frankly, most influential propositions in social media and online marketing, is that profits beget customer satisfaction.
Yep.
When you started in this industry, Ryan, Tom, and myself, we started and we had to educate somebody. We had to then fill out an application face to face. We then had to explain our fees face to face, right? We've all heard the term keyboard warrior, email warrior, all of that stuff. And what these large companies are doing is saying, yeah, we'll take low customer satisfaction. That's okay. Just get 10 clients per minute that do the clicks, and our profits beget customer satisfaction. So then why do so many companies, though, infuriate their customers by binding them with contracts, bleeding them with fees? Quite frankly, they're confounding them with fine print, right? And especially as it pertains to a mortgage. And it's because, unfortunately, it pays. So, it's great to know you, Ryan Grant, that my team, uses you guys to do a proper debt analysis, not just go to Ryan, he'll get you a mortgage. No, we don't want a mortgage. We want the mortgage that fits your specific situation today, and extrapolate that looking out over your short-term, medium-term, and long-term goals with how you utilize that debt properly for your family.
Yeah, it couldn't be more true. I'm hearing feedback, but one of the things that we've been seeing more and more of, Jeff, and I'd love to get your take on this, and I know we've talked about it offline, but for everyone watching, a lot of times we ask clients about, okay, tell us about your retirement plan, what's your strategy there? And it's always as simple as, well, we put as much money as we can on our 401k, the end, right? And at best, when it comes to investing or financial advice or guidance, they'll say, yeah, we plan on getting around to that. And, we'll probably just maybe we'll do like a online Schwab account or a, Vanguard or an E-Trade. And, we kind of we feel like we can manage that on our own. When does that make sense for someone? And when does it make sense? When does it not make sense for someone to, learn how to drive their own car?
Everything.
Right.
Yeah, DIYing things it is the new norm, right? It's let me Google a 401k, and then I'll just put money into my 401k. I think that DIYing is good because it's attempted to give people education. The problem is that with the current structure that we have in our country as it pertains to taxes and investing, and debt, is that every time you do one decision in your investment world, it's probably going to affect other aspects of your financial plan. I always look at a financial plan, Ryan, in six states, right? What's your cash flow doing? What are your investments doing? What's your retirement situation looking like? What are your insurances? Okay. What is your estate plan? And then ultimately, right, it all at the end of the day, though, is initially going to boil down to budget. We call it the B word. It's not what you make, it's what you keep, right?
Yep.
And so what we're seeing now is, nicely, with mortgage rates coming down, we are seeing lower fixed expenses from consumers right now. But really what we like people to do, and for those of you listening, here's something to take down: the 50-30-20 budgeting rule. It's a great rule, Ryan. We're basically sending, and we have something that we can with our listeners at the end of this, or you can email. I know there's something going along the bottom of the screen here. You can email us and we'll send this to you. It's a nice budgeting worksheet. Spend no more than 50% of your take-home pay on essential needs: housing, groceries, transportation, healthcare. Then on that, you want to then be spending 30% of your money on wants: clothing, dining out, gym memberships, entertainment, etc. And then 20% of that, emergency savings, debt repayments, retirement, investing, and college savings plan. Again, it all boils down to the B word: budget.
Yeah, something I just wanted to share is, I was watching this video the other day, Robert Kiyosaki on YouTube, talking about, the 3 levels of income, right? And how the government really just wants you mostly to have ordinary income because that's where they make most of the taxes. Jeff, can you just share a little bit on that? Like, I feel like, again, with this DIY culture, people have this idea that they can save more money, right? Which in a lot of cases, that's true. I've been at a store and I hopped on Amazon and was like, yes, click. I'm just getting that. Like, it's going to be here in 2 days with Prime. But I feel like nowadays, stepping over, right, $1 to pick up a penny, right, as the saying goes, like, if it works, right, and that's, I think, the value versus, this DIY consumer culture, right? Just do it. And how they're, I feel like in a lot of ways, companies are brainwashing the consumer. Jeff, can you speak a little bit to how that pertains, like, in the financial world?
Yeah. People don't realize the different tax structures. Now, before I go on, as a certified financial planner, I should probably give my disclaimer: I am not a tax professional. I'm not giving tax advice. So there it is. With that said, a lot of people, they get a couple bucks. A lot of us got a stimulus check, right, earlier in the year, and that kind of spurred this Robin Hood, let's go buy and sell individual stocks. Well, you could do that in many facets, but the first one, if you have no retirement account, is you have a regular brokerage account. Any trade, buy and sell, within a 12-month period is all ordinary income. And a lot of people don't understand that, Tom and Ryan. They go, oh, I made 10% in Tesla today. I made 8% the next day. Okay, just know that that's all ordinary income, the highest tax brackets that we have in this country. What if instead you were doing those same trades, I don't know, in a Roth IRA where it's all tax-free, or in a regular traditional IRA where it's tax-deferred? It's things like that where people forget to realize the tax structure of their investments.
Well, it's another good, that's another good example of where DIY was going to fail people. And it's not what they know and don't know currently. It's what they know and don't know that's changing. Good example is if we see Biden win the election, we're likely to see, interest rate or taxes go up from 37 to 39.7 federally. There's a bill in California to raise the highest tax rate from 13 to 16 something. Yeah. There's the estate plan tax change that, right now you can get 23 million, tax free, and that's going to be taxed moving forward. So all of these things is why it's important to have someone on your side, right? Because you can transaction your way through life, but who's helping you see the future? Who's helping you plan as your life changes and evolves, and as the rules change and evolve, right? It'd be one thing if we're playing with a consistent set of rules, right? Where all mortgage products are always the same, all financial products are the same, the tax structure is always the same. We could probably DIY that fairly decently because you know the rules, but those rules change month by month, year by year. And I don't know a lot of people who have created success or wealth by, going the cheap route, right? By managing expenses. Most people create success or wealth by getting advice and guidance around growth and strategy.
Yeah.
That there's no difference in the mortgage space as there is the financial space, as there is, education in general. And there is a reason why we don't teach real estate or finance anywhere in our young society. We don't teach it in elementary school, high school, or college. And you want to take a shot at what that reason is?
I'd like to hear what your take is on that, Ryan.
Demand down. No, shit.
Well, no, I mean, essentially, when it comes to the people who are writing policy around what's feasible to teach young children, and as people grow, it doesn't behoove them to create an educated society where people can make their own decisions and figure out which mortgage is best for them and figure out how to invest appropriately, right? Because it makes more sense for them to just continue working, right? As Tom's saying.
I think they are making some revolution, or there's some inroads there. I know that there are various schools, and I know that I personally have been approached to start teaching these classes.
That's
I
great.
actually taught one of these classes all the way back in, now I'm dating myself here, in 2008 at Hesperia Unified School District,
Nice.
where we do talk about the difference of what's a debit card versus a credit card. I mean, that's the simplest form right there that you want to be, teaching your young adults, especially children. For those of you that are listening that are 38, 45, 52, 60, with 15 to 25-year-olds, either at college or in high school, what's the difference between a credit card and a debit card? They look exactly the same. They have the exact same logo in the bottom right, and they have the exact same amount of numbers on the front. And yes, they have 3 numbers on the back. But what's the difference, right? And so simply we educate people. Credit card, you owe that money. That money doesn't just come directly out of your bank account. Debit card, exactly like it sounds, it debits immediately out of your bank account. Very different concepts, but a very simple concept that we want those of you out there listening to know.
Yeah. So just I want to be cognizant of time. We try and keep these to roughly 20 minutes or so. So Jeff, if someone is thinking of, investing money or starting out in retirement planning or just getting a better plan in place than they currently have, which may be none or a very loosely formulated one, why would it make more sense for them to utilize a financial planner such as yourself or someone maybe in their local market? Why would it make more sense for them to utilize them, even though the cost may be a little bit higher than if they went online and did their own version of it?
Yeah, I think there are 2 things, and one of them might surprise you. One of the biggest values that we give our customers is a sounding board. And quite frankly, one of the biggest values we give couples, husband and wife, or two married people, is we get to be their counselor. Finances create the majority of divorces. They're the most talked about thing in the kitchen and in the bedroom. And I can tell you I'm not a good cook, and you don't want me in the bedroom. So come to our office and we'll sit there and hash out those financial conversations that we have with people, because it's amazing when you dig into someone's perspective on money. I want to save. I want to spend. Okay, well, how do we come to that middle ground? So using us not only as that sounding board helps immensely for our clients. That's number one. Number two, what's the old saying? You need 10,000 hours to become a professional, right? So DIYing that, good luck. Get your 10,000 hours in. We can give you the websites to read, but it took me 4 years at Cal Poly San Luis Obispo, the degree in finance and economics, and another 3 years to become a certified financial planner, right? Just to get to where I am. All right. And so having the ability to speak all 6 languages, budget, taxes, retirement, investments, insurances, and estate planning, it's really an important vehicle, because understand this, finances are all intertwined. The second you have a mortgage, you introduce estate planning, you introduce taxes, you introduce cash flow. It is not just, oh, I got a mortgage, let's partition that and put it over here. The second you put money into your Roth IRA, you've introduced a tax strategy. Then you've introduced estate planning again, because you need to make sure that your beneficiary designation forms are properly filled out. It's things like that, right? So it's not financial planning as much as it is financial fitness. I wish I could go to the gym, Ryan, and do 10 bench presses and never have to do them again the rest of my life and look as good as you do right now. Okay. But no, we have to stay up on our fitness, right? And just like in our finances, you have to stay up on your financial fitness.
Yeah, I couldn't agree more. And that's why, and again, I'll share this just kind of before we part. The reason why we have the Art of Homeownership is to avoid you having to do things on your own. All right. So when you become a client of ours, or when you sign up for Art of Homeownership, and you can go to rgthomeownership.com, you could sign up and you'll have immediately all 6 of these services available to you, right? You get a home concierge service to help you keep your home in great shape and increase the home's value over time, which is like a personal assistant for your house. You get monthly real estate wealth digest. It helps you proactively plan for the future as things change and evolve. All the things Jeff talked about, our annual financial review, we do this every single year. So you may not have a financial planner. You may not be ready for a financial planner, but we help you understand protection, financial planning, generational wealth, real estate planning, credit and debt management as your mortgage provider, right? Which is extremely rare. Most mortgage companies sell you debt and say, good luck. Hope you know what you're doing, right? And now we don't offer those services, but we can refer you to people like Jeff or estate planning attorneys or accountants that can help you in those areas. We manage your mortgage for you, help you maximize wealth, and we help you relocate and renovate your home prior to selling. So all these things, again, the reason why I'm so passionate about this is because people think that doing it yourself is cheap. In the Quicken example, that it actually costs you $10,000 and you get a higher rate at the same time. So just transaction versus transaction, it's not cheap, right? But let's say you do find a really cheap online account, or you do go with the no fee trade type deal online, and you're there day trading, trying to figure out the markets. The likelihood that you will not take advantage of opportunities, the likelihood that you won't know that you're making mistakes, the likelihood that you won't have all 6 of those areas that Jeff just talked about really dialed in and continuing to plan in the future is really high. So when you think you're saving money, you better save a ton, because it won't be anything near compared to the opportunity cost and the 10 times the amount that we would probably save you or make you with sound advice and strategy and information when it's proactively done for the next 30 years. So please realize that this do-it-yourself culture makes sense for certain things in life. But when it comes to real estate, when it comes to finances, when it comes to things that are challenging or can be challenging, please have 100% certainty in all these other areas if you pick the cheap route. And 99.9% of America is not going to have that certainty, so they should pick the value-based route. So
Ryan, let me leave one tip for those of you who are still adamant about DIY, because this is one thing that everybody can DIY. With the impact of coronavirus that it's had on families, it's always important to review and update your beneficiary designations. For those of you listening, please go online to your 401k plan, retirement plan, taxable accounts, whatever investment accounts that you may have. Even go to your bank accounts and see if it's a POD account, payable on death, or not a POD account. Go on there, update your beneficiary designations, please. We have seen too many problems in the last 16 years of my career, but really in the last 12 to 24 months, that very painful for family members to swallow. I thought I had changed that. Nope, you haven't. And then, we know that the money's going elsewhere. So check your beneficiary designations. There you can see, are you giving money to somebody under the age of 18? Can you still do that under your beneficiary designation? Are you giving money to your mom, like everyone probably did when they first set up their bank account in college, right? Maybe that needs to change at some point. So go check your beneficiary designations.
Love it.
Yes. And Jeff had sent me before this. If any of you want some of Jeff's tips, he actually has some resources. I'm just going to quickly throw it up here on the screen. If you also want to email Jeff, go ahead and email Jeff. I'll throw his email right there on the bottom. Feel free to comment on this video if you're watching this and you got something out of it, or if you have a topic that you would like Ryan and I to cover in the future. Definitely. Also, I think it's somewhere like, how do I point right here? Ryan's phone number. If you want to text that phone number, you could actually ask Ryan for any of these things. You can, if you want to be kept in the loop as far as future episodes and things that we're going to do go, feel free to text Ryan. And that's it, guys. Hope you have a good rest of the day, and we'll see you next week.
Thanks, Tom. Thanks, Jeff.
Awesome.
Thanks,
Thanks.
guys.